Yeah, look, we're a little bit cautious on many of the IPOs. I mean, many of them are coming out of private equity who don't tend to be sort of, overly generous in providing gifts to investors. I think it's fair to say. I think, private equity, they're very clever people, and what they do well is, if they're doing their job properly, is they buy as cheaply as they can off the market, and they float, they sell it off to the market as expensively as they can. So I think one's got to be a little bit cautious, about some of these floats. It is a vendor who's bought something a year or two or three ago and is looking to exit. So you are getting in at someone else who's quite clever. You're getting in at their exit price. So I think one's always got to be a little bit cautious, And if you look at sometimes the hockey stick in earnings in some of these floats, it's I guess the best of that growth might be behind some of these things. If you look at Spotless, which we owned for many years, and not a bad company. Does a lot of cleaning, laundry, etc. And the earnings appear to have doubled in the last couple of years. Under private equity ownership, so they've done well. But you are buying now at a company, a very old established company in Australia, whose earnings have, been doubled in the last couple of years. So, we used to own them when the earnings were half this amount, and they didn't trade very well, and private equity paid what seemed a good price 2 years ago. And here, a lot of people are buying them now, and the earnings are double, and there doesn't seem to be a lot more, upside in terms of cost savings, etc. So I think one's got to be cautious.
And were you surprised that it had a strong debut?
Yeah, pretty surprised, yeah. But again, it's early days, shares are long-term investments, and sure, there's people very enthusiastic. There's numbers in the prospectus. I guess it'll come down to not just the delivery of 1 year's numbers, but I guess in terms of where the company is in 2 to 3 years. You see, when you take over a company, it's not that hard to sort of, boost earnings. You can cut things such as, a lot of discretionary spending. You can cut your advertising, you can cut your IT expenses, you can cut your marketing expenses. That's all very easy to do, which helps your earnings, this year and perhaps next year. But in the long term, if you don't invest in marketing, if you don't invest in IT, if you don't invest in advertising, you might find that the earnings 2 or 3 years down the road may struggle a little bit. And, we've seen that with things like Myer and Pacific Brands, previous private equity floats. They may look good for the first 6 to 12 months as, the prospectus numbers are reached. But thereafter then, to keep a company's earnings going 2 to 3 years in the future, one's got to invest today. And cutting costs drastically today to make a short-term number may have an impact later on down the track. So we'll see with some of these things. I'm not saying any stock in particular, but I think one's just got to be wary of the way one can boost short-term earnings to the detriment of earnings, 18 months to 2 years down the track.